Well, last week I saw a very interesting article that caught my attention. The headline of it was, "Are bonds broken?" And I thought that was a very interesting question, and it was most definitely caught my attention. And here's why. We all know that bonds let us down last year. Why? Well, bonds are supposed to be like the stable part of our portfolio, the foundation, but they didn't operate as a stable part of our portfolio. And I think in order to understand why they didn't perform the way that we expect them to, you have to understand the relationship between the value of bonds and interest rates. So a little bit of investment 101, and I like to describe it this way. We all remember a teeter-totter as a kid, okay? Now, I like to show this example and illustrate that my fingertips are interest rates and my elbow is the value of bonds. When interest rates go up, the value of bonds go down and vice versa. Well, what happened last year? The Fed jacked up interest rates. What do we expect the other end of the teeter-totter to do? Go down. Well, I don't know what the Fed's going to do, but they have estimated that they are going to, and this is straight from the Fed, I'm not making predictions on this, the Fed has estimated that they will potentially cut interest rates by 1% next year and 1.5% in 2025. Is that what's going to happen? I don't know. But if that were to happen, interest rates go down, what happens to our bonds? They not only pay us their stated interest rate, but we could potentially see some appreciation. Now, if the Fed were to stop raising interest rates, that could be fuel for our bonds and kind of a catalyst to jump up in value. Now, this doesn't mean that we all run out and buy bonds. It doesn't mean that we shift a bunch of money from stocks to bonds. All it is educational in nature. If you're the person who has said, I want to load up on money market investments because they're paying 4 or 5%, or add a bunch of CDs to my portfolio, I'll tell you, CD rates won't always be this high. In fact, when they go to mature next year or in 2 years, we probably won't have as favorable interest rates. But there will be bonds as an alternative. So again, for compliance purposes, this is not a recommendation to make a big major shift. This is purely educational in nature. So please make sure to bring up the conversation of bonds next time we talk if you think it's appropriate for your portfolio. Hope you're well. Talk to you soon.